Spain, Madrid. Okay, so what's the temperament like there?
Same old. I mean, I feel like people are still just waiting on the sideline. They want to talk about China, which is, I think, a big improvement, but they're still of the mentality rather be right and late than early and wrong.
Early and wrong.
Yeah. Although Spain investors, I think they, maybe because of the size too, like the bigger clients, institutional clients that I've met in London, that definitely of the mentality are still on the sidelines, not really doing anything. But the ones I met in Spain, I think maybe because they're smaller in size, some of them are family offices, more boutique wealth managers. They are a little bit more active and wanting to maybe take advantage of the fact that the big money hasn't come in yet now. Yeah. So they may want to rebuild their China position.
It's weird because we're talking about bottom fishing, right? And almost a year ago, when we started this conversation, you and I were talking about how this was almost a generational opportunity to build a book. And to quote, and this wasn't my advice, but to quote one of the mid-sized allocators whom we hosted here in Hong Kong, they said, we almost feel like the best advice for our clients is to put everything into T-bills or 80%, and whatever remaining you have in the 10 to 20%, just buy all out of the money call options on China.
Oh, wow.
And then don't look at anything for 2 years.
Yeah.
Right. Fast forward now.
Well, anyone that did that would have made a killing.
So time of recording, we're up more than 50% on HSI, CSI. Hong Kong's the best performing market year to date. We're now recording March 19th, 2025.
Yeah.
For all of those allocators you spoke to and were on the fence a year ago, what would you tell them now? It's okay. In your heart of hearts, what would you say?
I told you so.
That's right. I told you so.
I told you so. But, I mean, it is a conversation that, the question that they still ask, of course, is it too late or is it sustainable?
Is it too late?
And which my reply is, no, I don't think so. And especially this time around, precisely because of the fact that they still haven't invested yet.
Yeah.
Goes to show, in my opinion, there's this significant runway for this current rally. You couple that with still half of the valuation of the US market.
Yep.
Improving fundamentals, earnings. We're in earnings season now, but it does seem like earnings are improving across the board from companies. And you have the government basically declaring that they are completely pro-growth and wanting to boost consumption, which you don't want to bet against. So, I feel like the stars are aligning. And
I read your last email update to investors.
Yeah.
And there was a section there on who's buying. And tell us from your analysis, who's buying. When we look at the past couple of months, the pump was pretty severe.
Yeah.
By severe, it was pretty dramatic, right? At that time, HSI was already at 15%. 12-month rolling was 45 or something like that. Who's buying? It's clearly not the European investors.
Yeah, no. So I don't think the institutional money has come back yet. A lot of the flows that we see, I think it's really just portfolio rebalancing from hedge fund managers, some global equity portfolio managers, basically shifting away from other Asian markets. In particular, India has seen significant outflows since Q4 of last year. I think the latest figure I read was something to the tune of about 50 billion US dollars. And I think a little bit over 20% of that has moved into Hong Kong, with the rest maybe still going to the US. So I think majority of what we see on a global landscape is coming from just those managers rebalancing the existing portfolio. There's no new money being allocated. It's just shifting within the portfolio.
What about, regional institutional investors? Are they in China yet?
No, so I was just in Singapore just before this trip to Europe as well. No, they still haven't moved, even the regional players. Well, I guess if you look at domestic players, on the other hand, they have definitely moved.
So southbound flows?
Southbound flows, yeah, that has been a major driver for the current rally as well. I think a lot of that are also Asia managers that are just trying to take advantage of cheap valuation in Hong Kong. I don't think the national team is that big of a factor anymore. That was a big factor last year. This year, I haven't heard any national team buying into this rally. I think they're just sitting on a big pile of profit now.
Okay. So let's talk about last year. Obviously, it's some level of bottom fishing. There's a LinkedIn post I showed last year, which showed the bifurcation or the spread between GDP growth in Asian countries such as China and other BRIC countries versus markets.
Yeah.
And my comment at the time is this could be, again, a great opportunity to build a book since the market hasn't caught up to fundamentals yet.
Yeah.
And the feedback I got from that post was surprisingly negative, saying like, look, there might be a tactical play here, but I don't really see a long-term growth driver for putting money into China right now, generally speaking. Now, fast forward a year, not only are the markets up, but there have been incredible developments both on the innovation side, soft power, industrial modernization in many senses, AI, DeepSeek. How would you answer that question today? Is it tactical, meaning we're positioning ourselves because valuations are cheap, or is there a longer term growth driver here?
Yeah, I think one of the biggest obstacles when it comes to China investing in the past is that the market has never correlated with the economic growth of the country. And there has always been a phenomenon that global investors can't seem to grasp or understand. In my opinion, the reason for that is very simple. It's the indices are just completely off. I mean, if you look into its composition, unlike the S&P 500 today, which only focus on a few handful of companies being the dominant weight, all China indices is geared towards a few sectors. So you have, for example, the internet subsector represents like 40% of the index. Then you also have financials that represent 20% of the index, and that's already 60%. And not to mention that 20% of the financial sector companies are basically all SOEs. So the remaining 40% of the index, half of that are also SOEs. So you're only really just left with 20% of the index that supposedly represent the rest of the China economy. It's not a good representation. And I think that's probably the real reason why the market, so to speak, has never reflected the China's growth. Now, one thing all you need to do to kind of put that into perspective is if you just strip out the index from SOEs and private sector. I don't even need to do any stock picking. Just break out the private sector from the index. If you annualize return of that over the past, let's say 15, 20 years, actually outperform S&P 500.
Wow.
Yeah, so I think that is really where a lot of the opportunities in China come from. And I think that's the biggest misunderstanding.
So what you're saying is Western allocators or institutions are still looking too much at a headline number that is in no way represent. More importantly, they're leaving money on the table because if you actually look at the true constituents of the real economy, they're outperforming.
Absolutely.
And so this is an incredible opportunity for anyone who's fundamental based, right?
For sure. I mean, even just in the past 18 months, I mean, there are a handful of names that have gone up. We're talking about maybe 2-3 times. One name has actually gone up 7 times. And it's just a gold jewelry retailer. The IPO at like 50. Today it's already 720. I mean, that's just insane. Absolutely insane. So there are so many of these opportunities still in China that, like you said, I think a lot of global investors are leaving on the table with it because they're so much focused on the top line number.
So let's talk about another, I wouldn't call it, sort of like a negative narrative. I was listening to the Bloomberg Q&A session last week post NPC announcement. And one of the analysts, I guess he's a pseudo-analyst economist, was talking about how there's still a lot of problems with the Chinese economy that are keeping investors at bay, which I'm not even sure if it's true now that I digest it. Specifically, 2 areas. One is the property market. His comment was, or the panelist's comment was that it's getting worse. Is it getting worse?
Not from our perspective. Definitely not from the data that we look at as well. If anything, we're actually seeing improvement, a marginal improvement, be it at that, but still an improvement. If you look at transaction volume data, you look at sales price data of tier 1 cities, the transaction has already ticked up quite significantly. Even sales price has ticked up in tier 1s. Now,
you have numbers for us?
So I think on a year-on-year basis, for tier 1 cities, the sales price has gone up about 2%. Transaction volume is about 25%.
That's really good.
I mean, it's definitely much better. Now, of course, if you compare that to, let's say, 2019, pre-COVID levels, I think we're still down about maybe 40% from that time, from a transaction volume perspective. But the trend is improving. You go down to the lower tier cities, and we are seeing secondary homes, not primary homes, But secondary homes transaction environment has also ticked up. On a year-on-year basis, if you just look at the first 2 months of this year compared to previous 2 months, I think for tier 2 cities, they're up also about 25 to 30%. So perhaps it's too early to call that the real estate market, has bottomed now and is on its path to recovering. But I disagree with the statement that it's worsening. I don't think it's worsening. I think it's actually has bottomed. Maybe not recovering, but definitely not worsening.
Yeah, I mean, again, from the hat of an economist, yes, there are still problems. Yeah. But as an investor, we're looking at where the puck is going, not where the puck is today. And the puck is, from my perspective, that is a bottoming structure, even from a technical perspective, right? Yeah. We have a higher low, higher high. That's happening in both price and transactions. Yeah. More importantly, we're seeing volume start to pick up.
Yeah. And I think I understand where a lot of the economists are coming from. From their perspective, because the real estate market still plays a huge role in GDP contribution and GDP growth. So from that perspective, yes, it is a big drag. It is a big problem because it's not booming. But from our perspective as an investor, that ought to be the case. I don't think the government will allow the real estate sector to boom the way that it had in the past anymore. In fact, one thing that I've been consistently telling global investors is don't expect the real estate market in China to behave the way they did over the past 2 to 3 decades. At best, I think you're just going to see very, very steady below GDP growth in the overall sector going forward. The real gem, the real growth driver, I think, is exactly what the government has been trying to promote in consumption and innovation.
All right. So let me step in here. And I've read this from your update to investors. This number that you quoted was massive. Savings rate, roughly 20 trillion US dollars. The total bad debt exposure on real estate is roughly 1 trillion. So you have I wouldn't call it a coverage ratio, but about 20 times. And so when I read that, I went online and did a little bit of research. In the US, the household savings rate in aggregate is only about $1.1 trillion. And so I was like, what's the equivalent of the sort of Evergrande exposure that you would have in the US? And I think commercial real estate is probably the closest apple-to-apple comparison. That's roughly $850 to $1 trillion.
So that's already, and that's just commercial real estate.
That's just commercial real estate. So coverage ratio there is roughly 1.1 to 1 versus a 20 to 1 coverage in terms of real equity versus bad debt, right? So, and I know it's not a fair compare, it's more academic than anything else, but it really shows where the pool of liquidity needs to be tapped.
Correct. I think it definitely put things into perspective, if anything, that the situation, is bad because the sector has been a drag to the economy, but I don't think it's catastrophic. And like you said, the real growth driver isn't going to be coming from that. It's going to be how do you unlock that 20 trillion US dollars of savings that are just sitting in banks at the moment. If you can tap into that, even just, let's say 10%, that's already more than any government stimulus can implement. And it's immediate. When government announces stimuluses, just like what they have, it takes time for that to filter down into the economy.
And just for the audience, what did they announce for the stimulus? Because NPC came up with a couple of things. Break it down for us.
Yeah, so now we're just getting more details. So when it comes to consumption, they're going to be extending the cash for clunkers program, basically exchanging your old cars for new EVs, trade in for old home appliances that will continue. They have allocated central government budget to cover basically local government debt as a debt swap program.
From municipal debt. That's where the heavy burden is at the municipal level.
And they are essentially extending a lifeline to the local government for them to lend more to private businesses, as well as to basically extend loans to the real estate developers that need them. That's really the bulk of everything that has announced. Now, the MPC has also talked about innovation, and they are gonna set up basically a sovereign wealth fund that will invest directly into that sector. I think DeepSeek is going to be one of the first targeted companies that will receive that state funding or state investments. So they are also setting up a lot of capital to try to play into this innovation drive.
Let's take a step back. You made a comment about how the deficit budget is basically increased to the level that we haven't seen in 30 years.
4%.
And GDP. 4% of GDP. The highest budget in 30 years, more than GFC. More than SARS. More than COVID-19. And for me, this is the bazooka. This is the money printer.
The funny thing is, the bazooka really came in September of last year.
Agree. They just didn't put a number in it.
They didn't put a number in it. But the way they did it, in my opinion, is already a big bazooka.
Yeah.
Funny thing is, when you fast forward to today, they are still announcing all these things and we're basically increasing the numbers that are tied to these programs. Already, like you said, unprecedented in the history of the country. And yet, there are still many investors that ask, what more can Beijing do?
Yeah.
When are they going to really launch that bazooka? Honestly,
But I don't get it, right? If you
I
look
don't
at
get it too.
the last 3 NPC meetings, the biggest complaint, the number one overarching complaint that I had from even managers here in Asia was it's not specific enough.
Yeah.
There's no clarity. And when that announcement came out the last 2 weeks, I was like, what more do you want?
Yeah.
And clearly they're listening. They're listening to the market.
Yeah.
So do you want a number? We're going to give you a number. Before, I think we talked about this last year, it's really about reading the tea leaves and the vector and the trend. That was the best way to interpret policy in China and investing in China. And it felt like a lot of managers here, even locally, were over-interpreting policy, being contrarian for the sake of being contrarian, thinking that they would follow a previous behavioral pattern they did before, bailouts, etc., QE, in surprising the market with capital. But the regulators were very clear 4 years ago that they were going into a deleveraging state, right? That they were going to tighten up the liquidity, that they were going to dry up some of the excess liquidity in the market. And a year ago, they said, okay, we finished. Now we're going to start opening up the taps.
Yeah.
And nobody believed them. And now you have an actual number and the budget plus clear policies that are going to drive the market forward. I'm not sure what more you want.
Yeah, I agree. I mean, to be fair, because of the sort of the bad experiences, so to speak, and this is exactly why they're in that mentality that they'd rather be right and late than early and wrong, because they had been early in believing that would help the market.
But they were too early.
They were too early. And they were burned number of times, not just once, but number of times, to the point where now they feel like, what makes this time different from before? Because it seems like every time is different. I think that's the tough part in rebuilding confidence and regaining trust.
Do you think the case for China right now is competitive given what's happening in the US and Europe?
Yeah, I was just about to say, I think if it's a standalone issue, I think regaining that trust, rebuilding the confidence is going to take much longer time. Despite what the government is already doing, they've been very consistent in implementing what they say they're going to do and so on and so forth. Luckily, with what's happening in the US, I think it's actually helping to level the playing field for China. I think one of the biggest mistrusts of obviously China investments is the discount that global investors have on the government structure and the regime that governs the country. There's a misalignment of values, so to speak. And that's the big discount that China faces, historically speaking, and definitely more recently. But I think that understanding is also shifting because of the Trump presidency and where he is also throwing out all these value-based considerations. And he's much more transactional. He just wants a good deal. And when he does that, I actually think it puts China on more equal footing.
Why?
Well, if both countries are not really caring so much about these value type of analysis,
Then there's no negotiation.
There's no negotiation. Then let's just look at, again, back to the basics. Which economy is growing faster? Which government is more supportive of the economic growth of that country? Which country has more companies that are growing faster and with a much more diverse base?
So let's talk about the tariffs real quick.
Yeah.
There's an economist who was on TV, actually they were on Bloomberg as well, a couple of weeks ago. And they were actually elated about the fact that Trump tariffs were only about 25%. That managers locally were expecting much more severe tariffs than what's actually being released. So first question, do you agree? And number two, do you have a sense why?
It's funny because the companies that we speak with, and they are in our portfolio, they actually are not too worried about the tariffs, like be it 25%, even 60%. We were actually working under the scenario of a 60% tariff.
Exactly. So why not? 25% by any measure is still pretty hefty.
Yeah.
Why aren't they not worried? Is it because of supply chain deleveraging?
Yeah. If you ask me, and I have to take a guess, look, the Trump administration, I think they're very practical in general. They're just much more transactional in nature. They obviously want what they think is best for the US. And one of that barometer that they focus upon is the stock market. And this time around, I think Trump presidency really surrounded himself with technocrats, people that actually understands many of these market dynamics.
Right.
There are a lot of financiers that are in his circle now.
David Sachs.
Yeah, David Sachs, exactly.
Right?
Yeah.
It's a billionaire,
Correct.
hedge fund manager, private equity manager.
That's right.
Elon Musk obviously
Yeah.
has interest both
in
China
US and
US.
China. Yeah.
Right.
And I think very quickly they realized having a escalated tariff war with China is probably not a good idea because of the supply chain. And China also has more than 7 years to prepare for this. Obviously, companies in China have already diversified their manufacturing base to counterbalance some of these additional tariffs.
That's a really good point because if I remember correctly, the first sanctions and tariffs were actually in Trump's first administration.
That's right.
Trump version 1.
Yeah.
There's something like 200 and roughly, let's just call it 200 sanctions plus tariffs that were imposed on China in the first. And then Biden came in and it feels like he didn't want to be too soft on China. So he doubled the number of sanctions plus tariffs on China. So wondering, is this round of tariffs low because they kind of capped out?
I don't think so. I think it really just comes down to supply chain. Like where, to give you some figures, rare earths, minerals that are critical to basically many technology industries, semiconductors, EVs, power grids,
Military,
aerospace, even consumer electronics. Okay, China controls basically 90% of all rare earths refining and mining on this planet.
Wow.
One material, tungsten, has the highest melting point amongst all metals. It's the greenest of all metals. It has no harm to the environment. Increasingly being used in defense, aerospace, nuclear power plants, which stuff that you absolutely need, especially if you want to transition into full EV and AI adoption. You need power to run these things. So there's going to be a massive increase in power grid build out. China controls 97% of all the production of tungsten in the world. And US produce basically nothing, zero. So now I'm not saying you can't replace China. I mean, at the end of the day, it's mining, right? So
exactly. I was about to say there are other sources.
There are other sources that you can source from.
Absolutely.
But the issue is you need to invest in that, and you need to open the mines and setting up the mines. That takes a lot of money and a lot of time. First, I don't think there will be a lot of government-backed projects to open a lot of these mines. I mean, this is a very dirty type of jobs. China obviously have the state-backed entities like SOEs that does this. Other places, not so much. So you're going to need the private sector to invest in that. Then what's the return on capital on something like this? Probably nothing. Or for a very long period of time, you're not going to really see any type of return. So that itself is already a huge barrier and obstacle to find an actual replacement. There are replacements. It's just that for all intents and purposes, it's uneconomical to use those replacements. And that's where I think China continues to understand and continues to double down. You see them increasingly want to control the supply chain for many of these, what I call critical materials, as a way to dominate or at least even the playing field when it comes to tariff negotiation.
I think you're right. I almost feel like time has gone by so quickly since that first administration. And you've had 8 years now for a central policy government, right, like China, to pivot and adapt. And you're right, it does take time, but they've spent the last 8 years decoupling. And I think the number that US, at least in one sense, such as the EV market, only represents like 16% of China's exports, as an example. But in areas like rare earths, it represents 90% of the demand factor in the US. One more negative narrative I do want to ask about, demographics. And this is something that I was asked last week by an allocator. How are we going to, or how is China going to deal or overcome issues like youth unemployment? And is that really a material issue for growth moving forward?
No. I think this whole demographic problem is way overblown. Okay, youth unemployment in China is high at the moment. I think
10%?
Maybe a little bit higher. I mean, I think officially it's 15%, but unofficially maybe 20-25%. But you look at India, officially it's 40%. Unofficially, maybe half. You look at Europe, in places like Italy, Spain, I think youth unemployment is also 20+%. So I think it's a phenomenon that we're seeing globally and not just in China. Now, with that said, you also look at historical youth unemployment of China over the past 30, 40 years. Has always hovered at about 15%. That didn't stop China's growth in the first place, right? China still grew at double digits. To answer your second part of the question, I don't think youth unemployment is really that big of a factor. In fact, I'm even willing to go ahead and say that it probably have very little, if any, impact to consumption growth. We've all been there. We've all been young. We've all been college students. And When was the last time you see a college student really be a big spender? I mean, unless
Spending my parents' money.
yeah, exactly. Unless
Credit cards, student loans,
sure. I mean, unless
government's money.
you have the parental
That's
support.
right.
Otherwise, you don't have any money as a student or as a youth. Consumption growth had always been dependent upon people that have worked for a few years. So basically, age 25 and up, all the way into retirement. You look at the unemployment rate for that group, that cohort in China, 25 to 60, is basically at historical average about 5%.
Wow.
So I think this whole thing is overblown. Now, with that also said, I also going to give you another way to look at this. Another problem that people worry with aging demographic in China is productivity is going to fall. You're not going to have people to work, and then that's going to drag down GDP as well. But interestingly, if you look at the labor participation rate over, the 40, 50 years that China has experienced this miracle growth have remained basically the same. Meaning the number of people that are in the workforce or that participate in the workforce hasn't really changed. It hovered about 50, 55%, even though the population expanded quite a bit. So what that figure tells me is it's not the quantity of people that drives productivity. Because people are worried that, aging demographics, you have less people in the workforce and that's going to drive down productivity, meaning the number of people is a big factor. I argue differently. I think it's not the number of people that drove the miracle growth that China saw. It's the education improvement that increased the productivity of China.
4.7 million STEM graduates.
Every year.
Every year.
Every year. More than any country in the world.
I don't know what the number in the US is, but I think it's something like
less than half.
Less than half.
Yeah. So in my opinion, is the quality of education over the past 30, 40 years that continue to improve, drove productivity, that obviously play into innovation and so on and so forth. The number of people doesn't really matter too much. Now, let's just take a step back. Let's just say, for argument's sake, okay, fine, this is a big problem and demographics is aging and all that. China still have a lot of tools that they can use to just extend the problem. They don't even need to deal with it in the next 5 to 10 years. Yeah. The one thing they do, and they have already done, is increase the retirement age. They recently increased the national retirement age by 2.5 years.
Wow.
I think from 55 to 57.5.
Right.
But 57.5 is still significantly lower than the global average of 65.
Yeah.
Right. So let's just say they match global retirement age at 65. That already extend, another maybe 8 years. That allow them to address a lot of these issues. So I think a lot of these problems is more academic in nature. As an investor, as someone that's trying to just create value for our client base, we don't see this as an issue. If anything, it's actually creating opportunities for us. Robotics, automation, all of these.
Okay, so let's talk about this. DeepSeek, January.
Yeah.
A week later, I think it was Quen. Recently, it was Baidu.
Yeah.
All launching AI models. And you have this open source movement, which is not dissimilar as a response to OpenAI and Grok, which is not dissimilar to what we saw with like iOS and Android.
Yeah.
Right. iOS, centrally controlled, high quality, premium experience. But then you have Android, which came out as a response to that. And that enriched, tens of thousands of small businesses to come into the ecosystem. And to this day, I think there's still far more Android users and derivatives of that than there are iOS users, despite deleting iOS as a single platform. So when we look at China and AI, how is this in your mind transforming sort of like the local demographics, transforming companies? And how is that making you think about how you're positioning your book?
Yeah. One thing I have been arguing is, honestly, I don't understand why the US is so bent out of shape in trying to sanction China on the technology front, simply because I think the approach of the two countries had always been quite different. The US had always been into having the most advanced tech and having the leadership position in having the most advanced everything, anything. China, on the other hand, had always been about how do I optimize so that it'll be widely used, so that there'll be full adoption. And DeepSeek, I think, basically kicked that off in China. And basically, probably globally now too, because of the fact that it's much lower to train this model and still perform much better than the rest of the world.
What I find remarkable is that because there's a deflationary effect to that, which reduces the cost to access the technology for small and medium businesses. And it feels like it would accelerate the mid-market even further. Where, case in point, the enrichment of OpenAI for Microsoft and other high CapEx for Mag 7, that enriches these companies. But I get the sense looking at just where the market is going domestically,
Yeah.
a lot of companies are spending CapEx on AI to help them improve efficiencies
Yeah.
in traditional industries and not just robotics.
Yeah, I agree. And that's one of the reasons why we don't want to invest in basically the AI developers themselves. I think the competition there is going to be very fierce. Although I think that will help a much faster adoption of AI in everyday use. In fact, I think what we're seeing now is AI could become, let's say, WePay and Alipay did for people. It basically digitalized the entire life. I think similar effect we're going to see AI have on everyday use and even for businesses. But with that said, I do think competition is very fierce. Like the EV market, when EV became a thing, everybody started to launch EV vehicles.
Yeah.
And on one hand, that's great for consumers because you have so many different choices, prices are falling, innovation is,
It's scary for investors.
but for investors, it's very, very scary.
Yeah.
Great for consumers, bad for investors. And I think we're going to see that play out within the AI developers market. So the way that we want to position for something like this and for this big structural trend that is, in my opinion, will continue is you will probably want to invest then in things that will be more of an AI enabler.
Okay.
You
Can you give me an example? Like what that would
so
look like?
any businesses that have a huge Internet of Things can benefit a lot from this.
Gosh, I'm thinking not just the EV space, could be even consumer electronics.
Yes, consumer electronics is a big part. I mean,
Manufacturing.
Yeah, anyone that have a big penetration in people's homes that have already rolled out, so various different products and had always been about creating this ecosystem, like Xiaomi, for example. I think they will be a big beneficiary of something like this.
Yeah.
We kind of touched upon this before as an enabler, power infrastructure. You have a full rapid adoption of AI that going to require a lot more electricity as a way to drive some of these AI servers.
You're right. So power, utilities, data centers?
Data centers, yes, but data centers is a very low margin business. It's not
see.
something I think that as an investor is something we look at. But, power grids, equipment, and things that go literally to the source of electricity, that could be something quite interesting. Because if you look at power grids, not just in China, but around the world, it's extremely aged.
Yeah.
I think the average build, like the time for a power plant that has already been used is about 30 years globally. So to have that much increased demand in electricity, I think you're going to see a massive expansion, capex investment to upgrade and enhance existing smart grids. Well, if you look into what components are used, China is a fast and rising global exporters in that part of the industry as well.
It feels like there's a pretty good alignment between fiscal policy, monetary policy, advantage over geographic competitors, the US and India now. All lights are green, but for you as a fundamental bottom-up manager, what keeps you awake then?
The number one thing that can still derail, basically everything that we talk about, in my opinion, isn't geopolitics, isn't tariffs, but still is really the real estate market. So that is the number one risk because, yes, in my opinion, it won't be the biggest growth driver for the future.
It's bottomed out.
For now, it does seem like it, but what if it somehow reverses trend? If the government isn't able to put a lid on this or control this, then I think, everything that we talked about doesn't really matter because we will continue to be in a downward spiral for the economy.
So put yourself in the government's position. You and I know what they've rolled out since September.
Yeah.
Is it enough? And number two is, if you were them, what would you do?
Yeah, to tackle this issue, one thing I would do is social housing, like increase that as a way to absorb some of the excess inventory.
They kind of announced it.
They kind of did. I think it's ongoing, but I think the pace and the magnitude isn't big enough. I think they can probably do a little bit more on that front. And also related to this too, they also probably should look into the root cause as to why historically people use the real estate market as a way to protect wealth and grow wealth. The root cause is the social safety net for China is very weak. The social pension system is very weak. I think the average pension that a citizen gets outside of tier 1 cities is 200 RMB.
Wow.
200 RMB a month. Like, are you kidding me? Like, what?
Yeah.
What is that?
It's not.
It's nothing. Yeah. So I think...
But they would argue that the deflationary pressure on goods and services makes it at least affordable, even if it's a lower pension.
Yeah.
Plus the other non-monetary social services.
Yeah, but the deflationary pressure is counteracting what they really want to do is boost consumption. Because when you're in a deflationary environment, you probably don't want to spend more.
Yeah, yeah.
Because price is going to keep dropping.
But we're going into a reflationary regime now.
That's what they want to do. And I think to expedite that and to really help that, I think they ought to really reform social pension or sort of the social safety net that the country has.
So let me zero in. Property, real estate still has some risk there. Is it linked to consumer spending, which is, as we pointed out earlier, $20 trillion?
Yeah.
The exposure on property, as we sort of looked at, roughly $1 trillion.
Yeah.
Why is it a worry? I mean, if we can tap into just, as you say, 10% of it, the velocity of capital, plus the trickle-down effect, theoretically should offset that exposure.
The issue itself, I think, is a bit chicken and the egg, like which comes first. The reason why savings keep going up is because people feel like they're not getting richer, like their wealth is shrinking. And the reason why they feel like their wealth is shrinking is because the real estate market keeps tanking. Because basically about 70% of household wealth is tied to the real estate market.
This is past tense though, right? Is it still tanking? It's not still tanking.
It's not tanking anymore. But I think for that effect to actually feel like
the wealth effect
to come through, I mean, we haven't seen it yet, to be honest. Yes, I think you look at the data, it looks like things are not worsening anymore, even to a point perhaps there's some recovery, but I don't think that has translated into the actual wealth effect for households.
Got it.
So you have to wait for that. But during this period of time, a government misstep, some other unforeseen issues, whatever they did, just kind of start to reverse again, then we are in a bigger place.
So yeah, I would argue that for me, last year when Evergrande went into receivership offshore, that to me was in crypto we call it the FTX moment, when the news is so bad, but the market doesn't respond.
Yeah.
And so for us last year, that was the FTX moment for China when Evergrande went into receivership, market tanked 10%, but within 72 hours, it got picked up.
Yeah.
And ever since then, we've been looking upward.
Yes. So like I said, I think the official data does show that things are improving, but if you talk to the average person in China, they haven't felt that.
But that's often the case. Real economy participants are often going to feel a lot more bearish.
Yeah.
But from the perspective of a money manager, I look at that as news because now I want to accumulate as much as I can.
True.
During this phase. Like this is, again, perhaps the second, maybe even the third best accumulation phase before things turn up. Because by the time the property market or real estate market works itself out, valuations will be far priced in than they are today.
Yeah. That I do agree. I don't think markets react after the fact. It has always been before things start to work out.
Let's take the commercial real estate fiasco, right? In the US, that's sort of lingering there, which still might even blow up depending on where we are, right? If you ask any US economist, their response is, well, we don't need to work out the entire $1 trillion. We just need to stabilize, right? By the time we work out the entire $1 trillion of bad debt, we're already in bull market. We're probably past it already.
I think for the US, that makes a lot of sense. For China, it probably will pan out the same way over time. But one thing that I think China needs to do is to re-educate the general population that there's other place to essentially build and create your wealth. And that's the capital market. That is also a bit of a struggle as to why we're not really seeing that wealth effect pick up as quickly as one would like to see.
Yeah, participation is not that high on.
It's not that high.
And they don't have access to global markets either.
That's right. And that's another frustration for money managers like us where, yes, we do have that long-term view and that long-term approach. And like you said, we ought to accumulate during this time. But because we don't have that huge source of capital like the US market has, valuation tends to take a much longer time to re-rate. Yes, you can argue that's fine. I mean, you can wait it out, and then just keep accumulating. But let's be honest, I think a lot of investors are probably not that patient. And that's exactly also why, again, chicken and egg, you also have that trust and confidence eroded for a lot of global investors where they feel like they have been burned one too many times. How long do I have to wait for the real thing to turn around? Why is it not translating back into the capital gain despite the fact that we are seeing fundamental improvement? Okay,
so let's translate that in how you run your book, right? So the argument that I'm having now with some of the other managers in the debate even for today is, are we looking at, clearly it's actively managed. We have to be actively managing the book. We're not in accumulation phase like we were last year.
Yeah.
So if we are actively managed right now, are we kind of long biased? Are we long short? How are you thinking about this as a book? Obviously it's a stock pickers market.
Yeah.
Right? Because a lot of the larger names have they're not priced to perfection by any means, but they've certainly come up a lot. those of us who were here last year were taking some profits. So we're probably expecting some consolidation phase, if not already.
Yeah.
How do you look at the portfolio management side?
Our strategy is quite simple. I mean, we just want to identify those businesses that are earnings compounders that despite all these headwinds and the economic issues, that they are still able to thrive in this current environment. And the thinking there is that if they can thrive now and continue to generate sustainable earnings growth, when the time actually does come where the economy is really doing well, they will probably shine even that much more. So that's how we go about, essentially selecting stocks and picking stocks. And I agree with you. I think right now it's a market for two types of people: for stock pickers, which we fall into that camp, and for traders. Because if you have a bit of, good market sense, this is the type of market that I think you can make a lot of money. And there are so many managers that employ that type of trading strategy and has done extremely well over the past.
Traders love volatility.
Yeah. Exactly.
And we're definitely
volatility, momentum. I mean, it's
all there right
all there right now. Of course, when the big money really does come back, then you also have that big beta factor. Then, rising tide, right? Everyone, all boats will do just fine.
I know you look at strong compounders, but if you were to pick your top 3 sectors right now, what would they be?
The number one will still be consumers.
Okay.
Just because you kind of alluded to this. Don't overread what the government is saying. Like they say they're going to boost consumption. Let's go. Exactly. Yes. So definitely consumption being the number one. And number 2, I think is more on the subsector side, like power, equipment, power infrastructure. I think you can look at it as a derivative play on AI and EV and etc. And that's number 2. And number 3, maybe more on the technology front. But I'm not talking about the AI developers, what we talked about.
Okay.
I think it's more on the overall enabler type of play.
Okay, enabler type of play. So like the Alibabas, Tencents, these are all big names.
Yeah, they're all big names. You can also lump them under consumers, because I guess consumer is such a big part that it will cover so many of the subsectors. Maybe that's not a good example I give. So maybe I'll just use another one. Another big overweight that we have at the moment is advanced manufacturing.
Oh, advanced manufacturing.
Yeah.
So this includes robotics, I guess?
Robotics is one of them. Other just component, even in the EV space or renewable energy space, and this is a bit different from the actual power infrastructure that I talked about. So more on the manufacturing bit of China, I think there's still significant room there. Just because like what we talked about in the beginning, I think China will continue to have a very dominant role to play in the overall supply chain of the world.
Well, look, I want to congratulate you. You guys had a stellar year.
I do.
And you've had an amazing start to 2025. And, I think it's just a matter of time before the institutions come in. With the markets moving the way they are, I get the sense at the time of this recording, they're probably rebalancing. They may not want to, but I'm sure the conversations at the IC level are different than what they were a year ago.
Yeah, yeah, definitely. Like I said, I think what is happening over there in the US is helping the conversation.
Yeah,
almost feel like because of a lot of the Trump administration policy, people are waking up to the fact that it's probably a strategic necessity to have some allocation to China.
I feel like they want to do it almost indirectly through Pan-Asian funds rather than directly a China fund. A couple of managers are talking to who are in conversations with their US LPs. And they're a little bit concerned about concentration risks of having too many US endowment or institutional investors. Because if they redeem, that could collapse the manager and fund. And number 2 is the America First policy could be very restrictive on other downstream investments.
Yeah.
Right.
Yeah. So I actually have been talking to a number of allocators where my advice to them is having a dedicated China not only is good for obviously benefiting from the alpha opportunities, but it's also good for risk management because you can then easily, so to speak, exit out of the country if and when something that asks you to do so.
Yeah.
If you do it via EM or Pan Asia, you can't. Unless you find a whole manager, but then you're going to lose out on the entire exposure to other parts of Asia. So I actually think EM x China or Asia x China, like similar to Asia x Japan, you have AEJC, Asia x Japan, China. I think it's actually a much more prudent way in managing a portfolio because you get the best of both worlds. You can look at it from a risk management perspective where when things don't really work out or when you feel like you just don't trust this region or this particular economy anymore, you can just quickly get rid of it.
Yeah, I think for them, it's really a subscription issue. They can't seem to get it through the IC because you have the one hand in the back of the room that says, do we really need to have exposure in this region? Whereas if you presented a Pan-Asia strategy, then you could obfuscate indirectly that you do have exposure in China.
Yeah, but then on the other hand, I feel like, well, precisely because the ICs question the fact that whether or not we even need an exposure, or maybe not to like Asia, but like specifically to China.
Yeah.
Having China as a dedicated strategy actually works well. Like when you don't want it, you just get rid of it.
Yeah.
But you can still have that exposure to
the rest of it.
The rest of Asia.
Yeah. That's a very fair point.
But let's see whether or not that will actually pan out to be true. We at one point we were moving towards that side with MSCI, inclusion factor increasing, and this pre-pandemic, of course, where there were increasing number of investors having dedicated standalone China allocation.
Yeah.
But that has gone into reverse over the past few years. Let's see what will come back.
Well, look, let's catch up in a few months. Yeah. Congratulations again. It's so good to
thank you.
see you and have you.
Yeah. And maybe in a few months' time, there will be again, we told you so.
That's the lesson for today. I told you so.
I told you so, yeah.
From Mr. Steven Luk himself. Thank you so much.
Thank you.
We'll talk to you soon.
Alvin. Thank you.